Hey everyone, welcome back. And if you're new, thanks for tuning in. I'm Woodrow Gregg at the Malone & Gregg Group LLC, your favorite red-headed realtor in Northern Virginia. In today's video, guys, I just want to go over a couple news articles for the real estate market that have came out this past week. That after reading them, that I found damn near mind-blowing myself. So the first one we got right here, let's dive in, is brought to you by CNBC. Goes over the 10-year Treasury yield. Treasury yields rose again this past Thursday, continuing to climb into territory we have not seen in more than a decade. As the Treasury yield climbed 10 basis points, hitting 4.23%, at one point hitting 4.239%, for its highest levels that we've seen since 2008. Imagine that. These are the highest levels we've seen since the market crash. Also, with the Treasury yield isn't just used as a sign for economic sentiment from investors, but it's primarily also used as a proxy margin for mortgage rates. So, of course, if we as we see an increase in the Treasury yield, we're going to be seeing an increase in the mortgage rates as well. So let's see what that has done for us on a 30-year and 15-year mortgage rate. Let's see what's going to be looking like. The average rate right now for a 30-year fixed mortgage rose to 6.94% as of October 20th, from 6.92% last week. And compared to a year ago, it was at 3.09%. I mean, think about it, guys. That's more than double of a jump right there. So for a 15-year fixed mortgage rate, let's see, we're averaging 6.23%, up from 6.09% last week, and well above 2.3% a year ago. The chief economist over at Freddie Mac says that the 30-year fixed rate mortgage continues to remain just shy of 7% and is adversely impacting the housing market in the form of declining demand. Additionally, it's not the only thing that's being impacted, but additionally, home builder confidence has also dropped to half of what it was just 6 months ago, and construction, particularly single-family residential construction, continues to slow down. So, I mean, of course, we're seeing a rise in the yield and a rise in the mortgage rates, so it's going to be bringing prospective buyers to back out just a little bit and slow the progression. So for that, brings us over to our article. So what's up with the builder confidence? Well, let's ask straight from the horse's mouth. This article right here is brought to you by the National Association of Home Builders. As rising interest rates, building material bottleneck, and elevated home prices continue to weaken the housing market, we see that the builder sentiment has fallen to for its 10th straight month in October, and we're seeing that it has dropped a total of 8 points to a 38. This is half the level it was at just 6 months ago. And this is according to the NAHB Wells Fargo Housing Market Index, or the HMI, which was released on the 20th. This is the lowest confidence reading we've been seeing since August of 2012, with the exception of the onset of the pandemic in the spring of 2020. High mortgage rates approaching 7% have significantly weakened demand, particularly for first-time and first-generation prospective home buyers. This will be the first year since 2011 to see a decline for single-family starts, said the chief economist Robert Dietz. And given expectations for ongoing elevated interest rates due to the actions of the Federal Reserve, seeing that 2023 is forecasted to see additional single-family building declines as the housing contraction continues. Now, while some analysts have suggested that the housing market is now more balanced, well, the truth is that the homeownership rate will still decline in the future quarters ahead, as higher interest rates and ongoing elevated construction costs continue to price out a large number of prospective buyers. Now, with the HMI takes a survey every 3 months, and they've been doing this for 35 years. So the Housing Market Index, brought to you by the NAHB, it gauges builder perceptions of current single-family home sales and sales expectations for the next 6 months, and determine if they're good, fair, or poor. The survey also asks builders to rate the traffic of prospective buyers as high to very high, average, or low to very low. So the scores we have gotten from this past survey, we're about to go over them right now, don't look too good, don't look too promising to me. Scores for each component are then used to calculate a seasonally adjusted index where any number over 50 indicates that builders view conditions as rather good than poor. So here they are. Here are the three HMI components. Let's see. All three HMI components declined in October is what we're getting for a reading. So these three things were sales conditions, sales expectations, and traffic of prospective buyers, showing that the current sales conditions have fallen 9 points, making it 45. Sales expectations have declined 11 points to 35, and traffic of prospective buyers have fallen to 6 points, making it 25. Now, looking at the 3-month moving averages of regional HMI scores, the Northeast fell 3 points to 48, the Midwest dropped 3 points to 41, and the South fell 7 points to 49, while the West posted a 7-point decline to 34. That's it for our video today, guys. Go ahead and comment your biggest takeaway from today, and make sure you go ahead and hit that like button and subscribe. We'll see you next time.